How do you minimize risk during trading? Do I sell at the moment the trade goes in the opposite direction? Or do I keep my diamond hands and keep holding Bitcoin, Ethereum forever? Well, I hope in the end of this video you'll have a better understanding, because today we're going to talk about risk management. First, let's quickly address what is risk. The definition of a risk is where an action or activity that could go wrong, and which means not in your favor. And there's actually two main types of risk. One is a systematic risk, which means that it applies to the whole market. It doesn't just apply to one segment or one company. It's for example, maybe how the inflation is so high, so the Fed is increasing the interest rate. This is affecting the whole market. Versus an unsystematic risk is where a risk is specific to a company or a industry, right? So how you can reduce unsystematic risk is by diversification. You can actually put your eggs in many baskets, and in this case it's a good idea because there's no reliance of your portfolio in one company or industry, so that in case one or two company crashes in your portfolio, it will not overall drag down your whole portfolio, right? So now that we understand these risk definitions, let's talk about some risk mitigation techniques. So there is the four main ones, and I'll go through them very quickly. Number one is acceptance. So risk acceptance. It just simply means that you accept the risk does exist and there's nothing can be done, right? Pretty pointless, actually, in my opinion. But it is also important to understand that sometimes you have to accept these risks. Number two is avoidance. And this is probably something you want to practice, and many professional traders practice the most. It is where you can actually avoid a risk, perhaps maybe during high volatility periods of a particular sector. For example, maybe when we're talking about crypto, how the crypto market was crashing during controversies, right? Number three is risk limit. And this is another important aspect, which we'll go into more depth. It means to put a stop loss, for example, to avoid excessive loss in your capital during the trade. And you probably have heard stop loss before. And today we're kind of going to go through it briefly using TradingView. So let's talk about this in TradingView. I just picked a example of a stock which has a channel up, right? So we talked about indicators and trends before, and we talked about how Finviz is a great website that kind of scans through different stocks, which tells you what kind of trends they're currently in, right? In this case, I just chose this stock, pretty random stock, but it has a channel up, and we'll use this as a good example for stop loss and profits. And it is not an in-depth course about the stop loss and profits, but in this case, as you can see, the stock is generally fluctuating up, right? And now it is at this point where it just hit the support in this case, and is supposed to, our I guess indicator is supposed to show that it will potentially go up to the top of the, well, in this case, the resistance. So how do we set a stop loss in this case? Because we expect that the support will hold very well, and we can see that on a daily time frame, it has held 1, 2, 3, 4, about 5 or 6 times, right? 5 times in this case. So it's a pretty strong support. So most likely it will still support in this case. So the stock should be going back up. But there are of course always going to be a probability, a chance where the stock will not continue to go up. There's nothing that's 100% in the stock market. So we need to make sure we can limit it, right? So how do we limit this risk? So let's say if the stock actually goes down below 40, right? Then it definitely means that it broke the support band. The structure breaks and is no longer as much of a channel up with this support line anymore. So in this case, we can safely say that if it goes below $40, then most likely it'll continue to go down. So in this case, we can actually set a stop loss. So first of all, we of course is going to buy this stock, right? We expect it to go up. We buy this stock right now, maybe around 41.7, and then we put a stop loss around 39.8. We do not want to put the stop loss at a whole number because whole number tend to have more attention from people, so it's likely not a good idea to put your stop loss, whether if it's for stop loss or whether if it's taking profit, as a whole number, right? You want to put it below the whole number for your stop loss, and also probably below it for the profit, right? Okay, so let's say we put the stop loss as 39.8, and where do we take the profit? Well, we can extend this trend line a little bit for the resistance, and we will expect it to probably go up to maybe 45 or 46, right? And maybe a safe bet is 44.9. We don't want to risk too much, so we can still take profit. Maybe we'll never reach the top of the resistance, but we can still take some profit. And in this case, we still have a much higher profit than the amount that we will lose, right? So that's a good ratio to take. So let's come back to the slide and talk about the last of the risk management technique, which is transference. What transference means that you're actually paying someone to transfer the risk to. And you may ask, how is this even possible, right? Well, this is actually a more advanced topic relating to options trading. And you may have heard options trading, but essentially you're paying an amount to limit your losses, right? It's not always worth it because you actually have to pay for this risk transference. So if we have the chance, we'll cover this in a future topic. Today we talked about risk management, and I hope it helps you better understand on when you should take a loss. And it's very important to understand that in risk management, you need to know to take losses. You cannot always expect for you to win your trades. This concludes our video. So if you like the channel, please consider subscribing to it. Again, it helps the channel tremendously. Thank you.